Markets don't collapse when things are weak, they collapse when things feel strong. That is the paradox at the center of every major market break, and it's why so many people are caught off guard when it happens again. The warning signs are almost never chaos or panic. They are calm, confident, a sense that the system is functioning exactly as it should. Periods like this always feel unusually stable, and history shows that stability itself is the condition worth questioning. Right before markets break, conditions rarely look dangerous. Volatility is low, prices rise steadily, participation broadens, narratives feel coherent and reassuring. Risk doesn't disappear, but it becomes abstract, something theoretical, something that belongs to pessimists who don't quite understand the moment they are living in. This isn't a failure of intelligence. It's a consequence of how human systems evolve. Every market cycle trains people to trust what they have experienced most recently. When downturns have been brief, when recoveries have been fast, when intervention has worked, the mind adapts. Stability becomes familiar. Familiarity becomes trust. And trust quietly turns into assumption. But here is the tension most people miss. Confidence feels like strength, while constraint builds invisibly underneath. That adaptation feels reasonable. It is also how fragility forms. Most explanations stop at psychology. They talk about greed, fear, euphoria, panic. But those emotions don't cause crashes. They reveal them. To understand why markets always crash, you have to look past sentiment and into structure. Because crashes are structural failures first, and emotional events second. At the end of every cycle, optimism doesn't feel reckless. It feels earned. Earnings have grown. Innovation has advanced. Liquidity has been available. Institutions appear competent and responsive. There is always a story explaining why the system is more resilient than before. But the important detail isn't the story. It's that the story stops being debated. It becomes background reality. And when belief becomes background, risk stops being questioned. This is where fragility begins, not with fear, but with confidence. Fragility doesn't announce itself. It doesn't show up cleanly in headlines or price charts. It builds beneath the surface as leverage accumulates and flexibility disappears. Leverage is broader than most people realize. It isn't just borrowed money. It is any structure that amplifies outcomes while reducing margin for error. Systems optimized for efficiency instead of resilience. Portfolios that rely on constant liquidity. Balance sheets that function perfectly as long as nothing goes wrong. As leverage spreads, markets become smoother on the way up and more violent on the way down. Gains accelerate. Losses are delayed. Risk feels manageable because it has not been tested. Rising prices justify higher valuations. Higher valuations justify greater exposure. Greater exposure reinforces belief. Eventually, the system depends not just on fundamentals, but on participation itself. This is the phase where patterns repeat, and it leads to an uncomfortable realization. When a system requires confidence to function, confidence becomes a point of failure. In a flexible system, shocks are absorbed and losses are distributed. Selling is optional. Participants can pause, reassess, and choose their response. In a brittle system, shocks are transmitted and losses cascade. Selling becomes mandatory. Participants act not because they want to, but because they have no alternative. This is the mechanical core of every crash. Before that reality became obvious, the system almost always felt safest. That was true in the years leading up to the global financial crisis. Markets were calm, credit was abundant, asset prices rose steadily. The dominant belief was not that risk had disappeared, but that it had been mastered. Housing prices climbed year after year. Financial institutions reported consistent profits. New financial products promised to spread risk so widely that no single failure could matter. Losses, it was believed, had been diluted across the system. Innovation was framed as protection. Complexity was framed as safety. Stability felt like proof of resilience. There were warnings, but they did not register as threats. They looked isolated, contained. The system appeared diversified, liquid, and robust. Stress, when it appeared, was brief and easily absorbed. Each recovery reinforced the belief that the architecture was sound. What was not visible was how much of that stability depended on assumptions that had never been tested at scale. Beneath the calm surface, leverage had woven itself into nearly every layer of the system. Institutions were more interconnected than they appeared. Balance sheets were stretched, not recklessly, but efficiently. Financial products were designed to maximize returns by minimizing idle capital. Liquidity was treated as permanent rather than conditional. Risk was not eliminated, it was transformed. Loans were packaged, repackaged, and distributed. Exposure was obscured by complexity. What looked like diversification was often the same underlying risk viewed from different angles. Institutions relied on the assumption that markets would always remain liquid enough to adjust positions gradually. Leverage did not feel dangerous, it felt sophisticated. The system did not look fragile, it looked optimized. That optimization came with a hidden cost. When everyone relies on the same assumptions, including continuous liquidity, stable correlations, and orderly markets, those assumptions become single points of failure. The structure becomes efficient but intolerant of disruption. When stress finally appeared, it didn't arrive as a dramatic collapse. It started quietly, rising defaults, localized problems, early signs that a small corner of the system was under strain. None of this should have been fatal on its own, and that's the point. Housing didn't break the system. Rising defaults didn't break the system. Those developments revealed that the system was already breakable. Once confidence in the underlying assumptions began to weaken, the reaction changed. Institutions didn't sell because they believed assets were suddenly worthless. They sold because they had to. Capital requirements tightened. Counterparties grew cautious. Funding that had always been available became conditional, then scarce. Liquidity, which had seemed abundant, evaporated. Markets that were assumed to be deep and flexible became one-sided. Prices moved not because value had disappeared, but because flexibility had. Assets were sold to meet obligations, not because of judgment, but because of constraint. This is where panic enters the story, not as a cause, but as a consequence. Fear followed the realization that choices were gone. Selling accelerated because it was mandatory. Losses spread because positions were interconnected. Prices reflected urgency, not fundamentals. The illusion of liquidity collapsed precisely when it was most needed. The system didn't fail because people panicked. People panicked because the system no longer allowed them to choose. And once constraint took over, the outcome was no longer negotiable. What unfolded was not unique. It felt historic because of its scale, but its structure was familiar. Confidence gave way to fragility. Fragility met a trigger. Constraint replaced choice. And the sequence played out as it always does. This was 2008, not as a date on a chart, but as a structure revealing itself. The instruments were modern, the narrative was contemporary, but the mechanics were old. This is why focusing on triggers misses the point. A policy error, a corporate failure, a geopolitical shock, these things happen constantly without collapsing markets. What matters is the condition of the system when the shock arrives. If the system is resilient, the shock is absorbed. If the system is fragile, the shock is amplified. This is also where many people misunderstand what seeing it coming actually means. This is the part people get wrong, even when they understand the pattern. Crashes don't happen because people fail to anticipate them. They happen because anticipation offers very little protection once flexibility is gone. By the time a system becomes structurally fragile, awareness doesn't restore liquidity. Understanding the cycle doesn't turn forced selling back into choice. The problem isn't ignorance, it's constraint. This is why people who intellectually understand that crashes are possible still experience them as devastating. Knowledge doesn't change the fact that obligations exist. It doesn't remove leverage. It doesn't create optionality in the moment it's needed most. Understanding this changes how you interpret everything that comes before a crash. Sophisticated capital doesn't obsess over precise timing, it watches fragility. And when fragility rises, behavior changes quietly, not dramatically, not publicly, but structurally. Complexity is reduced, dependence on perfect outcomes is softened, flexibility is preserved, exposure that only works in calm conditions is trimmed. This often looks unnecessary while markets are strong. It can even look foolish. But this is why the response is always the same. Late in the cycle, efficiency and fragility are often indistinguishable. Optionality matters more than foresight. Optionality is the ability to wait, the ability to choose rather than react, the ability to act when others cannot. Crashes are moments when optionality disappears for most participants. And this is why simply knowing that crashes exist doesn't help most people. The psychological environment of a real collapse is nothing like imagining one. Prices fall quickly, narratives fracture, losses feel personal and immediate, fear narrows thinking. The need for certainty overwhelms long-term perspective. In that environment, structure dominates intention. Those who are forced to act don't experience crashes as opportunities. They experience them as threats. Even if they understand, in theory, that cycles recover, they are constrained by obligation. They sell not because they believe assets are worthless, but because they must. This is how crashes become transfer mechanisms. Not moral ones, not deliberate ones, mechanical ones. Assets move from those who are forced to act to those who can wait, from rigidity to flexibility, from leverage to optionality. This isn't cruelty, it's arithmetic. Crashes are not anomalies. They are how systems reset excess. They clear leverage. They reprice risk. They compress long periods of adjustment into short, painful intervals. From a human perspective, this feels chaotic and unfair. From a systemic perspective, it is inevitable. Every cycle ends this way because human behavior doesn't fundamentally change. Optimism expands until it outruns reality. Leverage accumulates because it works until it doesn't. Stability is mistaken for safety. Late in the cycle, the absence of volatility feels like proof. In reality, it is often the final condition before transition. When the system finally breaks, it rarely does so with drama at first. It begins quietly, a crack, a surprise, something that looks manageable. Confidence reassures itself. Narratives adjust. Markets recover, briefly. But the structure underneath has already shifted. Flexibility has been exhausted. Liquidity is thinner than it appears. The next shock produces a different reaction. Selling accelerates, prices overshoot, confidence collapses faster than it was built. This is why crashes feel nonlinear, why they appear sudden, why stability seems to vanish overnight. It didn't vanish, it was consumed. Understanding this reframes the entire cycle. The question stops being when the next crash will happen and becomes how fragile the system has become. And fragility always increases during periods of maximum confidence. This perspective isn't about fear, it's about clarity. Crashes are not punishments, they are transitions. They are the moment when belief meets constraint, when leverage meets mathematics, when stability reveals its cost. Markets always crash. Not because something has gone uniquely wrong, but because nothing has changed about how human systems expand and contract. Understanding that doesn't tell you what to do, it tells you how the system works. And once you see that, stability never looks the same again. The most dangerous moment in any market cycle is not visible fear, it is unquestioned confidence. That is when fragility is most advanced. That is when leverage is most embedded. That is when transition is closest. Markets always crash because they are human systems. Humans believe, extrapolate, and optimize until belief hardens into structure. And structure, when pushed too far, always breaks. Not suddenly, not randomly, but mechanically.